Now we're going to talk about firm valuations. After we finished building pro formas and balance the pro formas, and then we can move on to figure out the firm valuation. To do this, we need to first calculate the free cash flows. Then we also need to estimate the WACC, make assumption of free cash flow growth after the first stage. Then we can put together estimate firm value. One of the important calculation is free cash flow calculation. This is an important calculation, and I'm going to first talk about statement of cash flow. So they has a lot in common, and the statement of cash flow covers listed cash flow activity by three categories: operations, investment, capital expenditure, financing activity. For free cash flow, this talk about what is the total net cash produced by a firm to both equity holders and lender debt holders. There are a list of different ways to calculate free cash flow, depends on which is the base number you start with. I will use this approach. Okay. So this is a breakdown, and this free cash flow calculation actually borrowed two main components when we prepare statement cash flow. So the cash flow from operations and cash flow from investment, we use exactly same two cash flow calculation first. Then we will add one more. So that is the amount of cash flow goes to the lenders. If you borrow money from the bank or corporate bond investors. So we will use after-tax interest payment to capture cash flow goes to lenders. The reason is after-tax is interest payment is tax deductible. Here is an example of a cash flow statement, and this is free cash flow. Okay. And as you see, these detailed items are one by one matched. So we will go to the practice later on. Another important thing we need to prepare is figure out the weighted average cost capital before we do the firm valuations. So typically, cost equity, cost of debt are the major two capital we need to estimate the cost. We can use a different growth model CAPM for cost equity. Cost of debt, we can use a credit rating matched. For example, we can match if the credit rating is A for their main corporate bond, then we can use average yield for this type of bond and use that as a proxy. We can use also fitted yield curve to see the relationship between the yield and maturity. And a lot of people like to use average cost from the financial statements. So one of the rough estimates is look at what is the interest expenses and look at the debt amount, then get average cost. So this measure depends on firms, sometimes could be quite noisy though. If we have already figured out free cash flow and estimated WACC, made an assumption of free cash flow growth in the future. Now we are ready to do a firm valuation. In this example, current year is 2019. We did the first stage financial planning pro forma for 3 years. Okay. So the end of the stage 1 is year 3, 2022. So the first thing we want to do is get terminal value. In this case, it's terminal value at year 3, 2022. We need to use free cash flow of next year, then divide by WACC minus G. Okay. So once we get terminal value, now we can discount this total cash flow. For year 3, we add free cash flow 3 plus terminal value. We can discount the total cash flow at WACC to come up with the current firm value at 2019. Okay. So if we subtract the long-term debt of 2019, we can get market value of the equity, right? So divide by the number of shares outstanding, then we come up with the stock value per share. So that's one of the popular way to do security analysis as well. Now let's take a look at practice. So I'm going to start with example 1 and look at the tab example 1 free cash flow. So we need to use pro forma information. What we want to do is the pro forma is already balanced. In this case, we use long-term debt, common stock together to balance our pro forma. Here I listed the cash flow statement. I'm already added the information for you. But it is one of the tasks you have to learn as well to come up on a list of items when we do the cash flow statement of free cash flows. So let me demonstrate how to prepare a cash flow statement for the first year, pro forma first year. Okay. Let's start with the operating activity. Net income, then add depreciation. So after that, we want to look at all the possible change in the current assets, current liability. So basically, they are net working capitals. So we will exclude cash from current assets. We will also exclude notes payable as this is short-term finance activity. Okay. How do we determine the signs, the positive cash flow or negative cash flow? So basically, we want to look at if this belongs to asset category or liability or equity category. If it is asset, okay, increase means you have to spend cash, right? Outflow. If it's on the liability, increase means you have raised more cash flows. So accounts receivable. So subtract change. I'm already going to directly consider this negative impact. I'm going to use current year minus pro forma, okay, new, old minus new. Next change in inventory. It's still old minus new, the same thing. Now we have only one more item in the current liability. Liability we will use new minus old. Okay, increase means inflow. Now we have a total net cash flow from operations. For investment activity, typically we want to look at the sales of fixed assets using gross fixed assets change. Again, increase means outflow. So I'm going to use gross, look at old minus new. Right. So that's the only item here. Now I move to the financing activity. The notes payable again, I'm going to use new minus old. There's no change. Long-term debt, new minus old. Common stock, new minus old. Okay. Also, I have to subtract cash dividend payout. From income statement, we have 549, so negative outflow. That's all in the financing category. Right, so now we have summarized cash activity in 3 categories. So let's look at the total net change in cash. Okay, so we have 50. Now look at the cash account. Cash account at the beginning of the pro forma year, we have 500. Then we end with 550. Right. So the net change, it is 550 minus 550. Right. So that is identical. Right. So this means verify our calculation is correct. So as we mentioned, cash flow statement is very helpful for us to calculate, verify free cash flow calculation as well. So here, I just copied the information from operating category and investment category. So these are 2 main components which is in common. To get the complete free cash flow, I need to do one more, which is look at after-tax interest payment to lenders. So I need two information. One is tax rate, one is interest payment. Interest payment is 184. We need to use after-tax interest payment. So we got 111. So the total free cash flow, we add up the three category. So 521. Okay, so this is example 1. From a balanced pro forma table, we can build a cash flow statement and a free cash flow calculation. Now let's take a look at example 2. So I'm going to, so this also is started with balanced pro forma. I'm going to quickly do one more time, and then we move to the firm valuations. Okay. Net income plus depreciations. Now look at all the change in current assets, current liability. Again, old minus new. I'm going to copy the inventory and other current assets. Let's check if they are same, right? So that's all item under total current assets, excluding cash. Now move to current liability. We have accounts payable. Okay, so that's the main thing we want to do. Again, we want to use new minus old. Okay, change in deferred tax. So total cash flow in the operation category. Move on to the change in fixed assets. Again, old minus new, the gross item. Intangible, I believe we don't have any real impact, but still we want to consider. Then we have total. Next, cash flow from financing. So short term is notes payable. We have again new minus old, 50 minus 50. Then we have long-term debt. Long-term debt, new minus old. Common stock, new minus old. Okay, dividend is cash outflow. Go to income statement. So that's financing. Let's all add together. Now let's look at all the three cash flow change together. Right, so we don't know if we did it correct or not. We want to now go to cash account to see if the cash change verifies the number we got. So go to the cash at the beginning of our pro forma first year. Go to balance sheet cash. This beginning is the end of last year. The end is 237. So look at the change from end to beginning. So 47, right? So these two numbers are identical, means whatever we did in the list of item are correct. So this cash flow statement will help us to do the free cash flow, right? Okay, so I am going to just use the same thing, right, as we verified here. Okay, I just copy it down. Okay, you have to do one by one. I'm just doing shortcut. Then I'm going to look at after tax interest payment. Again, go to the income statement, find out the interest payment, then times 1 minus tax rate. It is 35, right? So we got this amount. Then let's look at the total. Okay, so the main category plus this plus after tax. There's no security investment, so that item is 0. Okay, so that is a free cash flow. Okay, I'm already copied through to the other 2 years. So once we get free cash flow, we can copy down, and we want to figure out now firm valuations. So free cash flow is done. Next is we want to figure out the WACC. So these are some information given to us. Remember our target debt equity ratio is 30%. So we need to do what is the proportion of debt, proportion of equity, then figure the cost of equity, cost of debt. So let's do the weights first, proportion. So we can use 30%, divide 1 plus 30%. So this gives us the proportion of debt 23. The proportion of equity is the difference, right? So given beta, we will use a CAPM model to get a cost equity, risk-free beta time market risk premium. Cost of debt, we will use the cost of interest payment, cost of interest rate as a proxy. Let's now look at WACC, weighted average, right? Proportion of debt time cost of debt time 1 minus tax rate. Proportion of equity time cost of equity. That's it, right? So we get 10.4. Okay, so free cash flow WACC is done. Now let's do the terminal value, firm valuation, and so on. Okay, so first let's do the free cash flow for next year. So we have 3-year model as first stage. So free cash flow 3 time 1 of the growth. The growth is in the future after year 3, 2022, the free cash flow will grow at a steady rate of 3%. Okay. So then we can come up with the terminal value. Free cash flow of next year, WACC minus G, growth, right, the terminal value. So we copy down the free cash flow for year 1, 2, but we get total free cash flow 3 and terminal value together. So then we will now it's ready for us to figure the firm value. Okay. So this terminal value I'm just copy paste. Firm value, current firm value based on the WACC and the total free cash flows. Total cash flows. So that's it. Now firm value is 2019. So we need to do what is the stock value per share. So to do this, we want to do what is the market value of equity according to our calculation, right? Firm value minus the amount of debt. Okay, we go to the current amount of debt, go to balance sheet, go to 2019, the current year 2019 long-term debt, the current information, okay, as our proxy. So that's market value of equity. Then divide by the how many shares we have. It is stock value per share, 20.92, right? So if the stock price currently quoted 17.6, so stock current is overvalued, right? So this is a cash flow statement, free cash flow, WACC calculation, firm valuations. Now the next thing I want to do is build a scenario analysis, right? So we have these assumptions, and we go through pro forma firm valuation. We got this stock value per share of this information. So that's only one calculation. We want to look at different cases. What if a sales growth rate is changed, or dividend payout ratio changed, free cash flow growth rate changed? All these things could change, right? So we have 3 cases with different numbers. We want to see build a scenario analysis. Okay, so what we do is we go to data, go to what if analysis, pick a scenario manager, right? So right now I haven't built anything yet. I'm going to add cases. Case 1. So here we want to change sales growth and the dividend payout ratio. We want to change go to these two cells, go to input, we have sales growth here, comma. Then we also want to change dividend growth payout ratio, right? So I'm going to go back to the numbers. Okay, now click on OK. So right now it will show what is the current number entered in these two cells. So case 1, we want to change to 2% for sales growth. Dividend payment is payout is 60%, right? So that's one case. I want to add another case, case 2. So we still refer default the same two pieces variables, and but case 2, the number we want to do is different. Sales growth 4%, payout 35%, right? So again, click on add, build one more case. Again, case 3, we have 6% and 25% payout, right? So that's all. We built 3 cases listed. You may add it if you want. Now I'm going to summarize, okay? So by default, we will do a scenario summary. Okay, before we do that, we first want to report which variables we want to report in the summary table. So here, right, so depends what we're going to do. We're going to look at the current firm value and stock value per share. Current firm value is this one. Stock value per share is this one, right? So that's the result cell. Click on OK. Okay, so by default, this is produced in a new separate tab. Okay, so you can copy them, and you can also change name. So this is right sales growth. So this is dividend payout ratio. Result, we have firm values. We have stock value per share, right? Okay, right. So this gives you an idea that when these sales growth change to different set, how our firm value and the stock price change, right? So I will encourage you to definitely go through homework, which is very similar to all what we discussed in the 2 lectures, but you can start from scratch and kind of really go through step by step. Okay, that will be very helpful.